favor dividends or something else, and we'll find some consistency where things that tend to favor debt might favor like doing a dividend versus a stock repurchase, and vice versa with equity. So you get lots of the same kinds of things going on in these two chapters. We'll have a few extra things coming on in here too. Now, with dividends though, or this chapter, we're going to get a little bit of the mechanics out of the way as well. We want to see like there's some terminology to understand. Like how do you, like what's a dividend yield? How do you compute it? What's the payout ratio? How do you compute that? Right, all these sorts of things. So we're going to get some of that out of the way first. In here. Okay, so first things first. Kind of what's the relevance of dividends in the first place? Total return on my investment is the dividend yield that I get, so any income I get from dividends plus any change in stock price, capital gains. Now, what I just said, what's the relevance of dividends? I'm going to stay light in theory for a little bit. We'll get to it later, but I'll kind of go ahead and do a little bit right now. Remember in capital structure, one of the theories says that dividend or that capital structure is irrelevant. Remember that? It doesn't matter if you have debt or equity or some mix. It won't change your WACC and it won't change your value of your firm. That was that was with all those assumptions, no taxes, no bankruptcy cost, all that. Capital structure becomes irrelevant. Well, interestingly, there are people this day and age who believe that dividends are irrelevant. And here is their underlying structure of their belief. If you pay me a higher dividend, the dividend yield goes up. That part of my return goes up. But by paying out more cash as dividends, there's less to reinvest, so you grow at a slower rate. So G goes down. And so if dividends are irrelevant, whatever I get in extra dividend yield is completely exactly offset by lower G, by lower growth. And so my total return, so what matters to me, doesn't change, right? So they completely offset each other. They're a wash. That's what would make dividends irrelevant. To make them relevant, maybe if I increase the dividend payout, so the dividend yield goes up, maybe the growth rate does go down, but not to an offsetting degree. Or, that would be dividends are pretty good, right? I get a higher return. Maybe I get a lower return with dividends. Maybe when I divert some money towards dividends instead of growth, maybe my growth goes down even more, right? So that would be dividends are relevant, but they actually hurt us. Those are the three big theories in dividend policy. Dividends are irrelevant. They simply don't matter. They do matter. Having dividends gives us a kick in our return. We'll think about why that could happen. They do matter. Paying dividends hurts us in our returns. We'll think later on about why that can happen. There's a bunch of other theories that are secondary to those. Those are the three big ones right there. I'll give you names of the other two theories later, right, where dividends are good and where they're potentially bad. But for right now, just the mechanics. Total return is dividend yield, which is expected dividend, right? It's a D1. Not today's dividend, expected dividend over the current stock price, plus capital gains, which is growth rate in dividends, but it's also expected change in the stock price. Just look at some historical data. So this is going back to, I did it through the end of last year. So I haven't updated it through summer, but going back into the 1950s. So basically starting out with the same amount of investment. You can see how the investment would have grown over, about 72 years, right? The blue line, and you can't see the difference in them until you get over here. Over here, they're superimposed on each other. This is the S&P Price Return Index, which tracks the S&P 500, but looks at changes in price only. There's also an S&P 500 Total Return Index, which adds in dividends, right? So when companies pay in the S&P pay dividends, that's not tracked by the price index, just the change in price, just the G component. But the Total Return Index tracks both the dividend yield and the G component, right? So those two things together. So it makes sense the blue line is below the green line because we're leaving out the dividend yield. for the blue one. And how big of it is it? It's about 25% of the total return of the S&P. So it's not an inconsequential amount, right? You take that and you compound it over time, it's gonna make a bit of a difference right here. That's about 4,500 right there. That's about 5,500 right there. All right, so that's just kind of looking at the importance of dividends. Let's look at some of the things we're going to talk about. We'll come back to that in a bit. Let's look at some of the things we're going to talk about in this chapter. So we're going to spend most of our time talking about this right here, cash dividends. Normally when you hear someone talk about like a dividend, that's what they're talking about. So if I own 100 shares of Apple, and Apple pays $1 per share dividend, I'm going to get 100 shares times $1, $100 in dividends when they are distributed. Fair enough. Some companies, though, have what's called stock dividends. And a stock dividend is something a bit different. Instead of getting cash for the shares that you own, you get additional shares of stock. Or you get probably fractional shares of stock. And you say, that sounds great, but stock isn't a cash flow. Dividends are, right? And if I'm an investor interested in cash flow, I get the cash flow from a cash dividend. I don't get it from a stock dividend. Now, real quick caveat in here. I'm bad about this. Most people are. Lots of times I will simply say dividend, and I'm referring to cash dividends. We will know, or you should, hopefully you'll absolutely know when I'm talking about a stock dividend, because we'll be on that subject matter, talking about that exclusively. Outside of talking about stock dividends, if I say dividend, it's cash dividends that we're talking about, so keep that in mind. Getting cash to shareholders, right? Cash flow, so what makes me wealthier? My stock going up in value, but also the cash I receive. So I can either get cash from dividends or something this formula right here doesn't have in there. What we don't usually put in undergrad textbooks is there's another piece that gets often added to this formula right here. And it looks kind of like this. You can say return on my stock investment should be my dividend yield plus the growth in stock price, so change in stock price here, or the percent change in stock price, plus we'll say stock repurchases divided by my stock price. So the cash I get from stock repurchases as a percent of my stock price. That, you're not going to have a homework with that or a test question with that, but that could be part of the return. Lots of companies do stock buybacks or stock repurchases. Is that part of your return on investment? Yes, it absolutely is. It's an alternative to a cash dividend, right? So we have to have a way of putting it in there. Otherwise, we're penalizing firms and investors who get, who are in companies that do lots of buybacks instead of cash distributions through dividends. So stock repurchases. We'll look at one final or fourth item. It's a non-cash distribution. It's not even a distribution of shares, really. It's called a stock split. So kind of the way of thinking about this table right here, if I'm running a firm, or if I'm an investor and I want to collect cash flow on my investment, these are the two things that matter right here: cash dividends and stock repurchases. On the other hand, if I want to give my investors something without giving them any cash to do it, then I can either do a stock dividend or a stock split. These two are equivalent in all real facets. There are very minute little differences in accounting treatment, but that doesn't matter here in the finance world. They do the same thing. The big thing to understand is neither of those two at the bottom of that table provide the investor with any cash. They cost the company a little bit of cash for the cost of actually doing it, but they don't pay any cash to the investor. Right, so that's the important part there. we'll spend a small amount of time on stock dividends and stock splits. Probably we'll hit those on Tuesday when we get back, right? We want to spend most of our time on the top part of that table. Let's see. Let's get a little bit of kind of data, kind of establish more about dividends and repurchases and such. So here, I don't have a graph which is more up to date than this one, so I apologize on that. I would like to. But S&P 500, again, so not the entire market, just that select group of 500 large cap companies, quarterly buybacks. So the light blue part of these bars, so each going from this, these are quarters, right? So every bar is a quarter in each year. So the light blue are buybacks, stock repurchases. This is total cash distributed by S&P 500 firms to its shareholders via buybacks. And the dark blue bars that are at the bottom are the cash being distributed from dividends. And when you add these two together, that's the total distribution, right? Via buybacks and dividends together. So you can see a couple of things in this chart that are kind of, that tell us a lot about how companies behave. So what's the relevance of this period right here? Recession, right? And you look what happened to distributions, total distributions during that time. They fell off dramatically. So when times got tough, what did companies do? They pulled back on their distributions to shareholders. They paid out less. What happened in the years after that? Times got progressively better, and what did they do? They increased their total distributions, right? So when the economy's doing better and firms are doing better, they're generating more cash flow, they can pay out more, and they tend to do that. And when times get tough, they've got less cash flow, they tend to pay out less. Because remember what a use of cash flow is, right? Pay shareholders. That was one of our uses, do stock buybacks and cash dividends. What else do we get out of this? Well, what's really changing in each quarter as we went from building up to the recession in 08, to the recession, to coming out of the recession? What's really changing on there? I see a lot of volatility in total distributions, the height of the bar total. But where's the volatility coming from? The lighter blue buybacks, right? That's where the volatility is. In fact, you look at the dark blue, they're barely budging here. Down a little bit, but not much. And they're and not only that, when we pulled out of the recession and everything kind of came back, what snapped back faster? Buybacks. Did dividends go up? They did, but very slowly. So that tells us something else about how firms behave. When they don't like to decrease dividends, and when they increase them, they do it gradually. They're very cautious about increasing dividends. Right? We'll see that in this chapter, some reasonings behind it. They have a lot more flexibility, it looks like, with stock repurchases, right? That for whatever's going on, it looks like they can pull back on stock repurchases with a heavy hand and then ratchet them back up a lot more quickly, which means that investors must be a lot more tolerant of changes in stock repurchase policy than they are in dividend policy. Otherwise, firms would pull back on cash dividends just like they do repurchases, right? So there must be investors don't like that idea. Otherwise, it would have happened. So that tells us kind of how firms behave as an aggregate group. What about in different stages of the industry life cycle, right? What about young growth firms or old mature firms, things like that? Well, here's our life cycle again, right? So here's that startup stage, the growth stage, the shakeout, mature, the declining stage. Well, remember, these firms they're just starting. Their costs are up here and their revenue's down here. Their cash flow is even worse, right? They've got no money to pay dividends. But in fact, they need money just to try to stay afloat. So do the startup firms ever pay dividends? Do they ever do buybacks? Never. That does not happen. What about growth firms? Here. These firms tend to have the characteristic, if you guys remember, that they are beginning to get to the point where they're starting to become profitable towards the end of that growth phase. In fact, they may not even get there in that stage, right? Usually they're growing so fast that whatever they make has to be reinvested back into the firm, and yet they need even more money than that. So their cash flow tends to be negative in that stage. If your cash flow is negative, can you really afford to pay out distributions to investors? No. Remember, dividends and repurchases are a use of cash flow, not a source of cash flow. So when cash flow is negative, you're probably not going to distribute money out to shareholders. Cash flow tends to be negative here. In fact, they tend to have to borrow more money to have the capital support their high growth rates, or issue more stock to have the capital support these high growth rates. Let me skip a stage here. Let's skip shakeout and go to the mature stage. They're barely growing, so they don't need to reinvest a lot of money. They're the successful firms that have made it, that have survived all the weeding out where firms kind of die and fall by the wayside. So they're lean and mean, they're profitable, they generate lots of cash flow. They don't have a lot of use for it, so they might as well distribute it to investors via buybacks and cash dividends. And that's where you find most of your companies that do buybacks and distributions are in the mature stage, because they have tons of money, tons of cash flow with very little use for it. So give it back to shareholders. What about the stage that I skipped right here, the shakeout stage? If you remember, the characteristics of that stage are you're still growing pretty fast, way faster than is sustainable over the long run, but your growth rate is now starting to fall off. It's not as high as, each year is a little bit slower than the prior year, right? And that shakes out the industry where firms start to fall by the wayside because they can't survive it. Firms in that stage start, if they haven't become profitable in the growth stage, they start to become profitable in the shakeout stage. But more importantly, their cash flow tends to go from negative to positive, right? Because what? Their growth is slowing down, they don't need to reinvest as much money back into the firm. So all of that NOPAT, that after-tax profit they generate, more of it is getting kept by the firm because they don't reinvest it. What do they do with it? They can pay it to shareholders, right? Now, they're still growing pretty fast. Lots of these managers may not realize they're in a shakeout stage. They may still think they're growing pretty fast. So they may want to retain that money for anticipated future growth, right? Or they may say, I know we've been slowing down, but I'm going to try to keep our growth. I'm going to try to keep the gas pedal to the floor. I'm going to try to keep us growing fast. So I need all this, as much capital as possible. But I've got a lot, and investors are getting really irritated in our shareholder meetings because we have all this capital being, built up, and we're not paying it to them, and we're not investing it. They don't like us just having a big cash hoard. So we got to do something with it. So what do? Well, if we commit to a dividend, but we need money next year, once you commit to a dividend, there's no going back. Investors don't like you giving them a dividend this year and then pulling it away from them next year. It's like the signaling when you do an equity issue. We saw how negative that is. When you give a dividend and you pay it for a while and then you pull it away, you either reduce it or suspend it entirely. It's a very negative signal. So firms don't do that, and they understand that. So what do they do instead? If I've got cash building up, but I'm not certain that I'm going towards mature stage, I think I might need that some of that cash in the future. I don't want to commit to a big dividend because I might need that money later. So what do? I do stock buybacks. So you tend to get small dividends initiated in the shakeout stage, but a lot of the money being distributed there are buybacks because they're more flexible. We saw that with the prior graph. What about the decline stage? What would you guys think? What would happen in decline stage? You got industries that are becoming obsolete, right? Like Sears and such. Positive? They could be negative, right? Your NOPAT could be negative. In fact, let's put that equation up here real quick. Here's our cash flow, right? So it's our operating profit. That's our NOPAT, right? Minus our net investment. If I'm a mature company, I'm making a lot of profit. I'm not really investing a whole lot. So I got a ton of money I can distribute out to shareholders. If I were in that growth stage, I might look like this. Right? I got a bunch of money going to investment that's really, soaking up all my operating profit and then some. But the decline stage, we got let's see, so you're saying probably a lot of cash flow there?
Well, I was thinking from like the investment activities, like you're selling your assets.
Yeah, so they might be selling assets, which gives them a net positive there. The question is this gonna be a negative here or a positive, right? And how much does it offset that? That said, so we might need the money here to cover this, right here. But we do find that these companies in decline stage, more often than not, actually pay out dividends to shareholders. But not the typical kind we think about. It's cash dividends, but we tend to call them, so let's put over here a plus with a question mark, so maybe sign. These would be what we call liquidating dividends. In other words, when you sell off part of your business, you get a big cash inflow. It's a one-time thing, unless you sell off another part of your business next year. But that part's gone, right? So you can't count on selling that part of your business over and over again. It's not going to be a sustainable source of cash. It's a one and done thing. We don't have any use for it, so let's pay it to our shareholders, to our investors. So we liquidate part of our business, we pay the cash to shareholders as a one-time liquidating dividend. It's a one-time dividend. And they would say that in the announcement.
Do they ever do stock buybacks at the decline stage?
I can't think of any firms that have ever done that. Now, you might be thinking like reverse stock splits and reverse dividends and things like that to bring their share price up. And that does happen. We'll see that when we get to those and think about why. A stock split, real quick, is where you take the number of shares and you issue additional shares. A reverse is where you basically pull shares out of the market. It sounds bad, but it's not really. We'll see that later. All right, so that's related to the industry life cycle. The first two stages, you're not going to have either any dividends or any repurchases in intro and growth. Shakeout, you tend to start getting distributions there. That's where they start to emerge, but they will be predominantly stock repurchases because they offer more flexibility to the firm that does this. You get more reliance on cash dividends as the premier form of distribution in the mature stage because they're more stable in that stage. And then you go into decline, you still can get dividends, but you tend to get them in the form of liquidating dividends instead of any regular dividend. Okay. Some things about dividends. They are entirely discretionary on behalf of the firm. So if I'm running a firm and I've said, and I've been paying you guys $1 a share every quarter for the past 10 years, I didn't have to. I could have chosen to suspend that dividend entirely or increase it, right? In fact, you'd think if I'm becoming more profitable over time, I'd pay you more. And if I'm less profitable, I'm going to pay you less. But it's entirely discretionary. The board of directors will make the decision, right? The CEO and the CFO may go to the board and say, we think we should increase the dividend, and here's by how much. They propose it to the board, and the board gives they either sign off on it or they veto it, right? But it's the board that's going to make this decision. But here's the thing. First off, how often are dividends paid by companies that pay them?
Quarterly?
Usually quarterly. There are some companies that pay them once a year. There are some companies that pay dividends semi-annual every 6 months. There are some companies that pay them every month. They're usually associated with real estate, right? So like you think mortgages are paid every month. So maybe you invest in a pool of mortgages and you've got shareholders in your company that in your underlying assets are mortgage pools and you get cash flows every month. You might just say it kind of works administratively more efficient just to pay out dividends every single month off of that mortgage pool, and they tend to do that. But predominantly they're quarterly, so every 3 months we tend to get a dividend. By the way, I mentioned this before, when you guys do like your discounted dividend models that you have in other classes, you have a dividend in that equation, that's an annual dividend. So if you got $1 every quarter throughout the year, that's $4. That $4 would be in that discounted dividend formula. So here's the thing. My company's been paying dividends to you guys every quarter for the past 10 years, 40 quarters. That's entirely discretionary that I did that. But every time that I come up to the next quarter, I'm going to do a couple of things. We're going to decide, do we still want to pay the dividend? Do we want to increase or decrease? What do we want to do with it, right? So a decision on the dividend. We decide we're going to keep the dividend at $1 a share yet again for the 41st quarter. But it's not as simple as that. I have to go and make an announcement to the marketplace that, hey, we're going to go pay a dividend on such and such a date. We'll see the dates in a bit. I have to announce it to you guys. And the minute that I put that announcement out there, I'm obliged legally to follow through. I can't put an announcement that says we're going to pay $1 a share dividend on December 1st, 2023, and then pull the rug out from underneath you. I get taken to court for that. All right? So dividends are discretionary until they're declared. They're declared each quarter, or as often as, if it's a REIT or a mortgage-based thing, maybe every month. So they're declared every month. That's a lot of work. And then each month, once they declare it, they're obliged that month's dividend or that quarter's dividend. What's going to happen when you pay out these things? So a little bit of accounting here, right? When you pay them out, cash goes down and retained earnings goes down by a like amount. Balance sheets have to balance. So over here, assets, liabilities, and shareholder equity. I've got a bunch of assets on my balance sheet. So I've got cash, say is $100, and let's just say all other assets are $900. So I've got $1,000 in assets. Maybe I've got some debt. Maybe my debt is $500, and I've got some equity also at $500. So there's that at $1,000. Let's say I do a dividend that is equal to 50. When that gets paid, here's what's going to happen to my balance sheet. Cash is going to drop down by $50. Let's don't make it 50. Let's make it 40. I'm going to reduce cash by $40, so it's going to go from 100 down to 60, right? But now the asset side of my balance sheet is 960. It doesn't balance. So what's going to happen over here? I don't reduce my liabilities because I pay a dividend to shareholders. I reduce my equity because their ownership, their contribution inside the firm has been paid out to them instead of retained by the firm. So that becomes 460, and now we balance out again. So you're going to have the impact here and the impact over here. You know something else real subtle here? Before the dividend, I was half debt, half equity, 50-50, right? Look what's happening after the dividend's paid out. I've got more debt than I do equity. My capital structure has changed. You see that? So dividend policy and capital structure have linkages to each other. Firms that, it looks to me like when I do a cash dividend, it has the same overall impact as increasing debt in my capital structure. So anything that might make debt preferable probably also makes dividends preferable. See where I'm going with this? So we get that kind of influence here. Okay. What if I did a stock repurchase as well? Instead of a dividend, I paid you guys let's say these are millions, $40 million in stock repurchase or buyback. Oh, by the way, stock repurchase, stock buyback is the same thing, right? It's the exact same thing. There's no difference. There is no difference over here. There will be differences inside the various accounts in the equity account. Because you don't just get equity. It's not like one big thing mashed together. You get like retained earnings. You might get common stock at par, a whole bunch of different things inside the equity accounts. How accountants adjust those will change. I think it may have a slide in here. We'll see it again later. We'll look at it for about 10 seconds and be done. But it changes the components in the equity account, but the overall change in equity is going to be the same, whether it's a dividend or a stock repurchase. So accountants would say they're very different. From our perspective here, we'd say it doesn't matter because equity falls but the exact same amount, right, from a financial perspective. You guys aren't accounting majors, are you? Good, don't want to get in trouble. Let's see. Some other terms and some measures. So we know at the bottom first, we know the dividend yield, right? Dividends divided by stock price. The dividend payout ratio. So again, I'm kind of working my way up. Dividend payout ratio. Normally it's just going to be the payout ratio is what you're going to hear, right? So you're going to hear a payout ratio. It's the dividends paid out. Is the dividends recorded as a percent of earnings? So you think, why is that? Well,
Now you're looking at your income statement, you go from revenue down to net income. And let's say my net income is $10 million.
for the year. What can I do with that money? What are the two things that I can do with that money? Pay out dividends and what else?
Buying back stock.
Not quite. So it goes to dividends, and then the remaining part goes to reinvestment back into the firm. So what that means is that the equity account over there will increase by the amount of money that we're reinvesting. So let's just say the 10 million, I pay you guys $4 million in dividends, and then I go and reinvest the other $6 million. The equity account's going to increase by $6 million, right? But importantly, my payout ratio will be the amount of dividends, 4 million, divided by my net income, 10 million. So that is 40%. Now you might be saying, wait a minute, you can't do that. Payout ratios are dividend per share divided by earnings per share. And they're also computed that way. But let me show you something. So, I've got two ways I can do my payout ratio. So I can do it as total dividends divided by total earnings, so net income. Or I can do it by earnings per share over, I can do it by dividends per share over earnings per share, where dividends per share is simply total dividends divided by the number of shares, and earnings per share is simply net income divided by the number of shares. But you notice, if I take a ratio of these two things, algebraically, shares cancels out. So what am I left with? I'm left with total dividends over net income. In other words, these two ways of getting it give the exact same outcome. If I went back over there and I said, we've got total shares, 1 million shares, and that means my dividends, 4 million, divided by 1 million shares, that's $4 per share. And my earnings per share, my net income is 10 million. Across 1 million shares is $10 per share. So I could come up here and say $4 a share, $10 a share, that's still 40%. It didn't matter which way to do it. So why show you both? Maybe you've got income statement data in front of you, and it's giving you total dividends and total earnings or net income. Just divide total dividends by total net income, you've got it. Maybe you've gotten dividends per share and earnings per share. You do it that way, right? So they will both give you the same outcome. Okay. This one at the top, I threw in here because it's worth you guys knowing it. It's not in the chapter per se. This thing called a distribution ratio. And look at how it compares to the dividend payout ratio. This is, so the payout ratio is dividends divided by earnings, net income. This distribution ratio, we're still dividing by earnings or net income. We're still looking at dividends, but we're also adding in stock buybacks or repurchases. Let's say that this company, in addition, also did another $5 million in stock buybacks or stock repurchases. Then in that case, the distribution ratio would be the $5 million plus the $4 million in dividends over the $10 million in earnings. So that looks like 90% there. How high do you think a firm's payout ratio, or for that matter, its distribution ratio could be? What do you think the upper limit is? 100, so you pay out all of your earnings, right? What if you had a payout ratio that was 1.2, 120%? What's that firm doing? They're paying out 20%. They're paying out their earnings plus an additional 20%, right? So in this firm over here, we've got $10 million of earnings, and we did a $4 million dividend, but maybe we did an $8 million stock buyback. So 1.2, 120% payout. We paid out 120% of our earnings for the year. Can that happen? It actually does. It can happen a lot. And there's several reasons it can happen. Number one, especially from the dividend standpoint, firms don't like to drop the dividend, but earnings might drop in a period. And so they want to keep the dividend where it's at, right? The earnings have dropped below the amount they're paying as dividend. You say, well, where can they get the money? They could borrow. Can firms borrow and then take that money and turn around and give it to shareholders? They absolutely can. They can do it, and sometimes they do it. Do they do that as a long-term thing? No, because you can say it's unsustainable to keep borrowing money and then funneled out to shareholders. Why would you do it all, even in the short run? Because you don't want to drop the dividend. You want to maintain it. If you think that the drop in earnings is temporary, it'll come back, then why not borrow so you don't upset your shareholder base by dropping the dividend? So that does happen. There's another point about this too, why that 120% or something over 100% can happen. And it's this: dividends aren't really paid out of earnings. They're paid out of cash flow, right? So a company can have 10 million of earnings and substantially more cash flow, because big components of earnings are non-cash expenses like depreciation. You can actually be generating, 12 million of cash flow, but only 10 million of earnings, right? Or you might have 10 million of normal cash flow from operations, but you might have liquidated part of your business, right, in the decline stage, and have that cash you can pay out as well. So it's quite possible you can get payouts that exceed 100% on this ratio. That said, you don't tend to find firms doing that and maintaining those kinds of distributions for very long, right? Okay, so that's those three numbers right there. The next couple slides just looks at dividend payout ratios, percentage of earnings paid out as dividends, and I'll come back to that in a second, and then the dividend yield, the return you get from dividends, and it's looking at it by sector of the market. And for example, historically, energy, utilities, telecom, this is companies like Verizon, AT&T, T-Mobile, they pay out high dividends, whereas companies like Infotech, like Microsoft and so forth, pay out very low dividends, if any at all. And then as a result, that means that your yield, your return from those sources of income will be very low if you're a tech firm investor, and very high if you're like an investor in utility stock or telecom and so forth. And so you say, why in the world would it be the case that you get these sector differences in dividend yields and in dividend payouts? Well, it turns out that companies that are growing fast have better uses for that cash than to pay out to shareholders. And so that tends to be these companies and these industries down here towards the right. Right? It's better for them to reinvest the money. They'll get a higher return or generate a higher return for investors than investors could otherwise hope to get with the cash they get from the dividends. These companies over here, like utilities don't grow. They have a set market, they're highly regulated, right, by the state utility authorities. About all they can really do with their cash that's investment is to replace, blown out transformers or things like that when storms come through, or worn out equipment. And then all the excess they pay out to shareholders, to investors. So you would expect to get really high payouts in utilities and other low growth sectors of the economy. So that's what's going on here. These two slides are primarily explained by growth rates, right? Which sectors grow fast, and therefore, they grow fast because they earn a high return on their investments in the areas they're growing, and which sectors grow little to none at all. Let's look at some other mechanics. This is most of what we're going to be doing today, some mechanics on this stuff, okay? Dividend timeline. So let me go back a couple of slides. Remember what we said, dividends are discretionary, but once they're declared, they have to be paid. And when they're declared, it does mean that they are announced to the public. So a dividend announcement, a dividend declaration, it's the same thing. What's in that announcement? And by the way, a company that's a quarterly dividend has to announce each dividend each quarter. You say, well, what if they've paid the same dividend for the past 10 years every quarter? It does not matter. Each dividend they have to announce it publicly. And what are they going to have in that announcement? They'll say, we're going to pay you, so the announcement date's the declaration date, okay? That's that one. But in that announcement, they're going to give you 3 days. And they're also going to tell you how much you'll get per share. So it might be investors will receive $1 per share dividend. The dividend will be paid on December 1st of 2023. The stock will go ex-dividend on November the 25th of 2023. And the date of record will be November 26th. Hopefully they don't have any weekends on that. They've got to do business days on those days. And you can see what we have in each of these. So the declaration date, I get that. That's the announcement date. The payment date, I get that. That's when I'm going to see the money in my brokerage account, right? I'll wake up that morning and I'll open up my brokerage account on my computer, and magically I've got my cash from the dividend payment is in there. The other 2 dates are vitally important. So date of record, not so much, but the ex-dividend date is. So let me explain how this works right here. And by the way, I think your textbook says it's
it's 3 days, between ex-dividend date and date of record. It's actually 1 day now in the market. So the book's got a little bit out of date on it, unless they've changed it just recently. Let's see. Let me get some dates here. I can't use the 25th and 6th, they're Saturday and Sunday. So I can announce on a weekend, but I can't pay on a weekend or a holiday, and I can't have the ex-dividend or the date of record on a holiday or a weekend. It's gotta be on a business day when markets are open, okay? So let's see. Let's say I announce today, right? So today is the 16th. And let's see, December the 1st is a Friday, so that works. I'm gonna pay you guys on December the 1st. So 12/1 is gonna be the payment. You're gonna get $1 a share dividend. That's the last of those dates. I announced this stuff today, right? So 11/16, so announcement. Right, my declaration date with all the details in the announcement. So press release. In fact, you go to the company websites where they have investor relations pages, and you'll see the dividend announcements. They'll post them there. All right, let's see. Let's say that, let's do a short timeline. Let's say that the ex-dividend date is, let's make it here. Let's make it Tuesday of next week, the 21st. All right, so 11/21, that is a Tuesday. That's where the stock's gonna go ex-dividend. And then the very next day, right, 1 day later, the 22nd, a Wednesday, is the date of record. Let's put DOR up here. So those are my dates. Remember, the dividend's gonna be $1 per share. So let's see, when does the Central Time, right? Central Time for us when we wake up. When does the market open, or when does it start in the morning?
7.
Not quite, a little bit later.
8:30?
30. So market open is at 8:30 a.m. Central Standard Time. What would that be? That'd be 9:30 Eastern, right? So 1 hour later. Right? People in finance don't like to get up early in the morning, right? Or they do, but they don't like to show it to the public until late. When does the market close?
5?
4.
Well, 4 Eastern, 3 Central. So 3 p.m. Central Standard Time. So those are the market hours, right? If you're on the East Coast, it would be an hour later. Yeah, so it'd be 9:30 and 4 p.m. respectively. So why in the world did I put that up here? So here's what's going to happen. Let's put a dividing line right there. Let's say that the stock price, I'm going to get rid of all market volatility. Our stock never changes in stock price ever. It's hardly traded, right? It's very illiquid. It hardly ever trades. And right now, it's been at $10 a share every single day for the past month. Let's just say it stays at $10 a share, okay? So the market opens on Tuesday of next week, it's $10 a share. The market closes and it's $10 a share, okay? So that's the average price from day. It opened at 10, it closed at 10. The next morning, you'd expect it's gonna open at $10 a share, right? Our stock price never changes. It's gonna open, in fact, you think it's gonna open at 10 because that was its close. It's gonna open at $9 a share. Now, why did I pick 9? What just happened? It's the amount of the dividend. The stock price should drop by the amount of the dividend the morning the stock opens ex-dividend, right? So, actually, you know what I just did? I made a mistake here. Let me back this up. Right there, sorry guys. So we're at 10, like this here. We opened at 10, we closed at 10, and then the next morning we opened at 9. It goes ex-dividend on that ex-dividend date, right? So it means whoever buys a stock that morning, whether it's at 8:30 a.m. or any time during the day, is not gonna get that next dividend. They're buying the stock X or without the dividend. That dividend has $1 per share value, so you've lost $1 per share in value, so all you should have is the remaining $9. That's why it drops from out the dividend. I had a stock in my portfolio went ex-dividend last week, very late. Its dividend was about $2 a share. It dropped by, it opened about $2, or it dropped by about $2 a share. That day it was ex-dividend, but by the end of the day, it was down 25 cents. Why? Because the market was pulling things up, right? But it still had to reflect that dividend. So by the end of the day, it may not be down by the amount of the dividend because of market dynamics. But the dividend itself, that's less value you have as a person who buys it on that day without the dividend. You're not gonna pay for something you're not gonna get. So that's why the stock is worth less ex-dividend than it is the day before. So what if I had done this? What if I had said, you know, if I own the stock on this day right here, I've got stock worth $10 a share, and I've got cash, you could say future dividends of 0, so I've got a total of $10 of value there. But one of you guys who buys the stock on that Tuesday when it goes ex-dividend, you've got stock worth only 9. But you know you're gonna get a dividend of $1 a share in cash, so you really, oops, I'm sorry. Do like this. So that next morning, I get up and I've got $9 in stock price, and I'm gonna get $1 in dividend. I still got 10 right there. So my makeup of my returns changed, right, from just being stock to stock and cash, but it's still the same amount. I've got a slide right here that goes through the exact same thing with a company called Adams Resources. I took the information out of the Wall Street Journal. You guys can kind of go through that and see the dates, what we just did here, so I'm not gonna repeat that. This also takes the same thing and it computes out your dividend yields, your payout ratios, all of that, the same information right there. So I'm gonna skip over that one as well. Let's do a few more things with the time that we've got left in here. Let's skip over, yeah.
Oh, I have a quick question.
Yeah.
So whenever you have the ex-dividend, you have to own the stock prior to the closing of the previous day,
Yeah,
correct?
yeah, so let's go back to this real quick. So, let's just say that let's say I sold my stock the day before it goes ex-dividend, literally on the last second of trading, as close to the end of trading as I could possibly get. I'm gonna get that dividend, right? I don't sell my stock and I have it the next day, then I will get the dividend because I owned it when it was, because I still own it, I owned it before it went ex-dividend. So I will get that dividend. Travis back there decided to buy the stock that Tuesday morning. After it's gone ex-dividend, he's going to get it without dividend. So it's going to be worth less what he's getting. He's going to pay $9 instead of $10 for it.
So that chart would be, on 11/20, we would get that dollar instead of 11/21. Because Tuesday is the ex-dividend date.
Well, what's happening is I've got $10 in stock.
Oh.
I'm still holding it.
Yeah.
And over here, I've got stock that's gonna drop in price to 9, but I know I'm gonna get that dollar dividend out in the future. So I still got $10 of value, but its distribution has changed.
Got it.
You come in and buy it, you got a $9 investment. You could buy 1.1111 shares for $10 worth of investment, but the stock's gone down, you're not gonna get that dividend there. You might get the next one.
I'm probably just overthinking it, cause I know for Wednesday it's the date of register. So, you can sell the stock, like let's say you owned it, before X dividend date, you can sell it on the 21st and still get a dividend?
Yes, I can, but from the last dividend, whenever that was, 3 months prior, to this date right here, I could sell it any time in that window right there. Or excuse me,
And you
as
mean
long as
window-
as long as I wait until it goes ex dividend, and then I sell it, I collect that dividend.
Okay.
So let me get my dates right. I've got to keep the stock until it goes ex dividend. Whoever buys it from me is not going to collect that next dividend, but I will, even though I no longer own the stock. It's like jumping over a fence, right? The ex dividend, between the day before and the day of ex dividend, there's a fence there. If I jump over that fence, I hold the stock during that time period, I collect the dividend. If I dump the stock off first, I sell it, I had my dates wrong. If I sell it like at the very end of trading on that Monday, I don't get the dividend. I'm sorry about that. I'm thinking about the break. So I get $10, right? But I hold it, so the next day I wake up, I want to sell it, get $10 before it drops to $9. But the next morning I wake up, it's trading at $9, but then I think, oh, but I'm going to get $1 dividend. It's still $10, right? So it's like a who cares thing, right? The makeup's the same way.
Does the stock typically like just shoot back up to its initially priced?
When we go through the theories, we'll see some things that say dividends are good, some things they say they're bad. But one thing that usually makes investors in dividend stocks really happy is to see their dividend increase, right? To see that go up, and or anything that's good news. And when you see that, typically stocks don't drop as much as the dividend payout. So they go ex-dividend, they may drop, but not like the full $1. Or you could say they dropped $1, but then they came back, they bounced back some. Is it the case you could have $1 a share dividend and the stock drops by $1 and it does that? Yeah. Could you have it drops by $1, then it keeps going down? Yeah. What's happening? You've got other things going on. It may be related to the dividend or something else, but you've got other things going on. The dividend itself, just the pure accounting or just the pure mechanics of it, right? So you guys have had this term before, arbitrage, right? In Jadici's class. Yeah, so you probably start getting sweaty and have nightmares now that I brought that up. So what is that? That's a risk-free profit, right? If the stock didn't drop by the amount of the dividend, we could set up an arbitrage profit scheme to take advantage of it. And markets do not like that, because just the mere act of trying to get a risk-free profit, if I find it, I'm going to do it, and it's going to eradicate it once I do it. It's going to adjust prices, right? Like, what if the stock always dropped just 50 cents instead of $1 for that $1 dividend? Then yeah, I can set up a strategy where I make a bundle of return on it, and it'll knock out that arbitrage strategy. So arbitrage ensures that the stock has to drop X dividend by the amount of the dividend, but then it may move other directions beyond that from forces going on. Either company-specific news or market-specific actions could change it from there. All right, so I think that clears it up a bit better. All right, so let's look at repurchases real quick. We've got about a dozen minutes or so. Let's look at these for a little while, and that'll probably wrap it up for today, okay? We'll probably get back and do most of our math in the chapter, and it's not too busy. It's not too busy like it was. It wasn't even too busy in the other one, to be honest. It's more theory. Same thing in here. Stock repurchases. Company buys back shares from you, so you're giving up your shares to the company. They're buying them from you, and they're giving you cash for it. These are announced too, right? So buybacks are announced just like dividends are announced, but they are fundamentally different. For example, what dates do you have on your dividend announcement? You've got
when does it go ex-dividend? What's the date of, oh, by the way, the date of record pretty much doesn't really matter anymore. It used to be, before everything was electronic, it was a 3-day gap instead of 1 day. And it was done so that, like, I'm running a firm, and you guys are investors. And Sergi over here is someone, he's not an investor, he's my trustee. He's like basically a bank, like JP Morgan, right? So he's running at JP Morgan, he works for them, he's my trustee. So I'm gonna pay you guys $1 a share. There's 1 million shares that you guys own in the company, so it's $1 million that will go to you guys on December the 1st, okay? So what's gonna happen? I'm gonna put that money into an account, and Sergio is gonna make certain that money has been moved into that account. It doesn't have to be with JP Morgan, it's gonna move into an account. He's gonna make certain, as basically an independent entity, that the money's been moved and it's there for you guys, right? He's gonna do that. He's also gonna make certain that the records we have of which of you guys are supposed to get the dividends and how much, because how many shares did you have when the stock went from Monday to Tuesday, when it went ex-dividend, how many shares did you own when you leaped over that fence? He wants to know that as well, so he knows how much gets distributed to each of your brokerage accounts. Now that takes some time. It used to be back when everything was done paper, it took a lot of time. So they gave him 3 days. That wasn't very much time back then. Nowadays, 1 day is probably too much. You could probably do it like that, but they still just do it. They still give them a day to do this. There may be a time in the future where the ex-dividend date and date of record are one and the same, but still they give the trustee that 24-hour period to match up the records and make certain everything's okay before the money will officially go out. That's the importance of that. Financially in here for us, it doesn't really matter. It doesn't affect the prices of anything. Back to stock repurchases. So I've got these dates here. The only thing in these 4 dates that you find consistent with the stock repurchase announcement is the announcement date. That's the only thing. There's no ex-dividend date or there's no ex-repurchase date. There's no date of record. There's no payment date. Really? There's not a payment date? What usually happens with a stock repurchase is they do this. They announce it and they'll say, so here's an example. In fact, let me do 2. So, XYZ Corp announces today, November the 16th, that a dividend of $1 per share will be paid to shareholders of record on December the 1st of this year. And stock will go ex-dividend on Tuesday, November the 21st. All right, so you see what's going on there. That's $1 million, so 1 million shares, $1 million. That part won't be in there. Let's say I decided to do a stock repurchase instead of that $1 million. Here's how it might differ. So it might be XYZ Incorporated will or intends to pay or to buy back up to $1 million of its stock. But from November 16th to December the 1st of 2023. It's like, oh, okay. So up to, I mean, does that have to do the whole thing? No, flexibility. They could do the whole million. They could do 3/4, a half. They could do 333,000. They could do 0. Once you do a repurchase announcement, you are not obliged to carry through. But I suspect there'll be some legal ramifications if you kept doing these announcements and never following through. If you kept pulling back on investors, I think there'd probably be some consequences on it. But if you did pull back because of market circumstances, that does happen with these. So I don't have to do the entire amount, and I don't have a day I'm going to do it. I have a window of time. It might not even be from today till a future date. It might say starting March 1, 2024, and extending out to August 31st, 2024. If I give myself a half a year, what might I be looking for? Really good prices. I want to buy back shares, right? So maybe I want to get a better price for the stock. Like you guys want to buy invest at a lower price than a high price. Maybe I want to do the same thing, right? It'll be a few other things in the announcement as well, but those are the main things. So it could be the number of shares, or more likely, the total dollar amount that the firm intends to repurchase up to. It's going to say that. A window of time during which the repurchase might happen, if it does, so get all these uncertainties. When you guys do look at the balance sheet, the equity accounts, if you've ever seen on the balance sheet treasury stock, that when you see a company that has treasury stock on the balance sheet, it's always negative. And when a company does a buyback, they buy their shares, like $1 million, treasury stock will become $1 million more negative in equity. So they don't reduce equity by making it smaller, reduce it by making this treasury stock account more negative. That represents the dollars bought back in stock. Let's see, what else up here? The method of repurchase. So how can you repurchase stock? That sounds fairly straightforward. There's that real quick, I'm gonna skip past that. Here's how you can buy back stock. You can do an open market repurchase. You guys go through a brokerage, if you have a brokerage account, you buy and sell stocks, you go through that account, you buy and sell shares, open market purchase. Whatever the market price is, you're taking it, market supply and demand. That's going to affect your price. Could I go buy millions of dollars worth of stock back through just a basic brokerage service? I could, but that's a lot of demand for the stock, and that might affect the price, right? So I got to keep that in mind. But I can do that. Some repurchases go through regular brokers, and just like any of ours, but they don't have to do like the entire million in one day. I could spread it out over time, right? That window. I might say I'm going to do 10,000 a day for the next 100 days, right? I could do that. I could do a targeted repurchase. Instead of going to a broker who's then going to go and buy the stock back from any investor who ponies up their shares, I could go to a specific investor that's got a lot of these shares, $1 million worth, that can buy back all at once just from that investor. Like, who would have $1 million worth of my stock? Maybe a mutual fund, maybe a pension fund, maybe an insurance company. They have big portfolios. So I might go to one of them and see if I can transact with them. I might get a better price. I might have lower fees and costs by doing that. I skip the one in the middle, a tender offer. Now, one thing we'll see when we get back is there's an idea that when companies do stock buybacks, they're trying to signal that they've got better information in the marketplace. And what information is being signaled in a buyback? That the stock is undervalued. How do you best signal that stock is undervalued? Like what if the market price is $100? It's like that thing we did last week with the signaling theory, right? But the CEO and the board, they got better information. We think the stock is really worth $130 a share. It's undervalued, right? It's trading in the market below what it's worth, below its intrinsic value. I've tried to tell you guys that we're worth a lot more. You just don't believe me, right? So what could I do that might, and my compensation is tied to the stock price. So I'm getting really ticked off with you, investors, because you won't believe me and bid the price up so I get my bonuses and everything. So what can I do that might be a bit more credible? Put my money where my mouth is, or put the firm's money. How can I do that? I can commit to buying your stock back if you offer it up to me freely, so you tender it. I can buy it back from you at $130 a share, but I think it's worth. Now, why would I pay 30% more than what I could buy it in the market? Because I'm not trying to buy it low and sell it high. I'm trying to get the price up to where I think it is actually worth. I'm trying to signal that to you guys that it's really worth $130 a share. And I do that by taking $100 stock and saying a tender offer for your stock and a repurchase at $130 a share, a 30% premium. So that's how I can signal to you that the stock may be undervalued what's at.
Why wouldn't you just use the
You could. And it, like I say, but I started at 100, and that demand may push the stock price up, but it may not be conveying that signal to you guys that the stock, but then maybe it goes right back down afterwards, right? If I send a convincing signal to you that it's really worth $130 a share, maybe it goes up there and it stays there as a result. See, my objective with a tender offer isn't to repurchase shares, it's to get the price higher to get the stock price where I think it's trading where it's actually fairly valued instead of undervalued. It's a little bit different motivation for doing that. All right. I think that's good. Has to be a good point. We're done with time. All right. So you guys have a good break, and we'll finish this up.
What is that homework due for supposed? It's
Look
not
at that.
the same.
Oh, yeah. When is that next homework due?
Oh yeah, so
Is that
I
due to
didn't
tomorrow?
have the homeworks posted until yesterday after class. So I said I'd add a few days. I think I extended it out till Monday.
Wasn't it due tomorrow or something?
Yeah, so I made it till Monday of next week.
Same time as normal?
Yeah, midnight, yeah.
For a second, I thought it was at like 2.